more on the worse than expected U.S. jobs numbers and what that might mean for Fed action, the economy, as well as the markets, we are now joined by Peter Schiff, CEO and Chief Global Strategist at Euro Pacific Capital in Westport, Connecticut. Peter, great to have you with us today. And I want to start first by a note that you wrote back on December the 20th, basically saying that even though they were pulling back on their bond buying through tapering, that they were not going anywhere. The jobs numbers today, is that supportive of your argument?
Well, absolutely. You know, most people on Wall Street don't believe these numbers. They're arguing that it's an aberration, that we should ignore it, it's an outlier, that it's inconsistent with the data. But the truth is, it's very consistent. We've been getting mixed data. It's just that everybody is looking at the economic glass as being half full. They're ignoring the bad data. But the reality is, whatever good data we have is a direct result of the quantitative easing that the Fed is now threatening to taper.
But when we look at these numbers, I mean, it is slightly an aberration from what we've seen over the past couple of months, the 74,000 number. What do you think might be the right number, and why isn't it possible that some of the stimulus that the Fed has put into the market has in fact helped? We've gotten that unemployment rate down from 10% during the crisis to a much lower percentage. Why isn't that part of a reflection of the Fed's program here?
Well, first of all, the only reason the unemployment rate has come down is because people have left the labor force. It's not that the unemployed have gotten jobs. They've just given up looking. So that's nothing that we should be proud of or the Fed should be bragging about. The only thing that quantitative easing has helped do is exacerbate the problems and reflate the asset bubbles. So, yes, it has caused the stock market to go up. It has caused the real estate market to go up. But that is masking the problems in the economy. And in fact, we don't need higher stock prices and higher real estate prices. They're already too high. We're never going to have a legitimate recovery as long as the Fed is concentrated on blowing air into a bubble economy. That's all they're doing. And so we're not getting legitimate economic growth. And, you know, by the way, the 74,000 jobs that were created in December, more than half of those jobs were temporary jobs. So
right.
Who knows if they're even going to be around. Meanwhile, we actually created fewer jobs in America in 2013 than we did in 2012. So how is it that where's this jobs recovery?
So
it's an illusion.
So Peter, what do you think then is the impact that we'll see from the Fed in terms of their actions for 2014? Are we going to see an absolute repeat of 2013 in terms of the Fed continuing to stimulate the economy? And if that's the case, what does that mean for the market and the economy?
Well, again, it's not stimulating the economy. It's stimulating the stock market and the real estate market. It's stimulating the bubble. It's stifling real economic growth. But, yes, that is going to continue. Maybe the Fed is going to taper back here in January by $10 billion, but that'll probably be the end of it. And I still believe before the end of 2013, the Fed will be buying more than $85 billion a month in bonds and mortgages. It might be buying over $100 billion a month because the Fed is going to have to come back to the rescue of the economy or the markets with more QE. That's what's going to happen. The question is, when will everybody figure it out? When will the people buying the dollar and selling gold figure out that they've got it backwards, right? That we're slipping back into recession. And the reality of it is, we are facing an economic crisis that's much worse than what we had in 2008. If you remember, when Alan Greenspan left and Ben Bernanke took his place, everybody was praising Alan Greenspan, what a great job he did, and they expected more of the same from Ben Bernanke. Well, Alan Greenspan's bubble blew up on Ben Bernanke's watch. Now Ben Bernanke has made all the same mistakes as Alan Greenspan, only bigger, and when his bubble blows up on Janet Yellen, it's going to be much worse.
So, Peter, I think, in general, you have quite an out-of-consensus call. So, in terms of saying that the government, the U.S. government, is going to continue to not only increase, not only bond buy, but increase their bond buying program, how does that play out for investors at home right now? What do you think you should be doing in terms of really positioning yourself properly for the long term? What do you buy here and what do you sell?
Well, I'm going to keep buying what I've been buying. I'm buying the resource sector, buying precious metals. I'm buying emerging markets. I'm buying stocks outside the United States. You know, Canada, you got a lot of negative economic numbers that came out today, too. You got some bad jobs numbers today. You got the housing numbers yesterday. But a lot of that is a function of unrealistic pessimism in the resource sector. When when people figure out how much higher prices are going to go for resources and precious metals, that's going to be a big change up in Canada. So I think that there's an opportunity on your side of the border. The Canadian dollar got beat up pretty good today. In fact, it's the only currency that's down against the U.S. dollar, and it's probably a pretty good buying opportunity. I'm not sure how much lower the Canadian dollar can go, but I think that probably by the end of the year we might be seeing a tightening out of your central bank, because I think the numbers are going to be a lot better as a lot of maybe these unemployed people in the resource sector are going to find that their jobs are coming back, because so many people have underestimated what's actually going to happen in this sector, because they've overestimated the strength of the U.S. economy and the commitment of the Fed to take away the monetary stimulus.
Very interesting perspective. Peter, thanks so much for joining us.
You don't want to buy things when they're trading at a premium to their value. You want to buy them when they're at the biggest sale and when companies are begging you to take their gold from them.
You know, not only for the resource sector, but specifically the precious metals, which a lot of people have been investing in to protect themselves. How is your feeling on the metals and the resource sector in general? Are you still bearish?
Very much so, Dan, but that's the beauty of where we are in the markets. We are coming towards the end of the valley of darkness. And, you know, when people talk about the investments Warren Buffett did or any of these hedge fund managers, it's that lonely trade. It's the trade when you're standing by yourself. And, you know, when I went on national television and told everyone to sell their stocks, I was laughed at by a commentator when I said Canada's largest diversified mining company, Teck, would be, it's 50% overvalued, meaning that it's going to get cut in half. And the anchorman started laughing at me. Well, a year and a half later, they brought me on saying, well, you're right, is it time to buy? And I said, no, it's going to go sideways now. So what you want to do as an investor is find the absolute best management teams that are buying the stock themselves and have the financial acumen, they have the financial statements, a disciplined financial statement, which means they have money and they can go consolidate the companies that have great assets, but management teams blew up their financial structure, spending all their money developing these assets. And that's exactly how Ross Beatty and Robert Friedland and Lucas Lundin became billionaires in the 90s and early 2000s. This is exactly the type of market where you can add a zero to the end of your portfolio. But it takes discipline, and it's a very simple formula, but it takes a lot of courage. No one said it's going to be easy, but you can make a lot of money in exactly this type of market. Now, the price, as Warren Buffett clearly says many, many times, is just a reflection of what the market believes is today's price. But you look at, you know, what I went through with Copper Mountain. Copper Mountain, when we took it IPO, in the first day it went from $1.45 to over $2.25. Got it up to $2.85, and then we had the big crash in late 08. And it went to just over 30 cents. I bought the stock in the open market at one of the lowest, the lowest price it ever traded was 33 cents in the open market. I bought that stock. Now I'm a director and one of the founding directors of the company. At that point, everyone thought, oh, the company's going to go under, the price of copper's down, the markets are over. Within 3 years, I went on national television and said, if you want to learn how to make 10 times your money, you have to buy companies that nobody cares about today. And Copper Mountain was a perfect example. And it went from 33 cents to over $8 in under 3 years, and today is Canada's third largest producing copper mine. Okay, we have over 400 guys on site producing copper 24 hours a day, 7 days a week. So what I'm trying to get at is that when you're in the valley of darkness, it could go lower, but that's why you don't put all your money into the stock today. You find the company you really like and buy in tranches. That's what we do, and if it goes lower, and if the story hasn't changed, but in fact got better, we'll actually increase our position and average down.